Hi guys, welcome back to another video. My name is Sean, and today we're going to be talking about why bonds are collapsing, yields are skyrocketing, and why the so-called Fed pivot seems like it's never even happened. Today is the 11th of October. We just had our CPI and PPI report, and they came out hot. So if you think the markets are in for a smooth sailing and a soft landing, think again, because something big is brewing in the bond market, and it's trying to tell us something. So today I'm going to try and break that down for you. First off, on September 18, the Fed surprised the market with a 50 basis point rate cut, something most people thought would spark a bond rally, myself included. But what happened next? The complete opposite. Bonds tanked. TLT, the popular long bond ETF, fell in a straight line down, and bond yield shot up. So TLT is now trading at about $93 from $100. Now the 10-year note yield is above 4% for the first time since August. So what changed? Just a few weeks ago, markets were calling for 2 more 50 basis point cuts in 2024. Given that CPI and PPI are hot, it looks like those calls for being more aggressive rate cuts are completely wrong. The Feds were off the ball, and we're likely going to see... I'm going to go on a limb here and say we're going to see 25 basis points on the November FOMC meeting. More so because they need to save face, but the right thing to do would be to completely pause the rate cuts. You know, we don't deserve the rate cuts. But, you know, they're going to print if they want to print. But after the bond market's reaction and the latest economic data, these odds have plummeted to below 4%. That's right. Just a month ago, the yield curve had flipped positive after 565 days of inversion, the longest streak since the late 1970s. And normally, I repeated this before, but a yield curve inversion signals a recession. And if you're talking about when the market crashes, it's normally when this yield curve reaches 1%. It's teasing the 1%, so I thought the markets are going to crash, but they're going to keep printing into the elections, I think. They're going to keep this market propped up because they want to keep the incumbent party in. I've talked about this. It's more likely that the incumbent party stays if the market is still strong. So that's what they're doing. And let's not forget last week's blowout jobs report, or maybe 2 weeks ago. The US added 107,000 more jobs than expected, with the unemployment rate dropping to 4.05%. The labor market is running hotter than expected, completely blowing up the Fed's narrative that inflation is cooling and the job market is weakening. We saw that with today's CPI and PPI data. So what does that mean? More jobs equals stronger inflationary risk because people are being paid, they get to spend more money, fewer rate cuts are expected to hit. And it doesn't stop there. The latest ISM Non-Manufacturing PMI posted its hottest reading since January 2023, adding fuel to inflation fears. Markets that once bet on a dovish Fed pivot are now realizing inflation might not be going away. The odds of a 50 basis point cut in November have dropped from 50% to almost zero. The Fed is stuck in a tough spot. Inflation isn't falling as expected, but bonds are in free fall. Now, less than 5 cuts are priced in for the next 12 months. This is spelling long-term trouble ahead, you know. The bond market is rebelling, it's calling the Fed's bluff, and gold prices are rising. You know, we saw a little bit of a pullback in the last few days from 2671 where I sold, and I gave the call to buy back at 2609. Just a few days back, I wrote in the chat, I see gold still being extremely bullish. It is one of the true blue bull markets. What the fuck am I saying? I think oil still has a play, gold still has a play, and silver still has a play. Among all the markets, you see crypto is tanking right now. Equities are on a slow chop up, but it's kind of scary because it could just fall off anytime. China, it's chipping up and down. In terms of my interim market insights, I wrote this in my chat before, but I think, okay, it's just a gumption, it's a guess. I think US equities will pull back slightly into the elections. I know some people might be saying, based on seasonality, we're going to rise into the elections. I don't think that's true because in a few cases before, we actually pulled back slightly to the elections. I'm not saying we get a major crash, but a healthy pullback before returning to all-time highs in S&P, 585, 595, 600 S&P. And then that's when I think it's going to spell trouble, right after the elections. The big wave 3 move, if you're talking about Elliott wave, the big crash will probably come after elections. I'm saying January or February. I'm going to say as it is here, that is my stance. I think US equities are falling off a cliff soon. So, when we look at all this data, what can I say? The US government is just running deficits equal to 6% of its GDP while generating only 3% economic growth. I've said this before. This market is not healthy. You strip away government spending, and our economy is actually shrinking. Here's the harsh truth. Mr. Market is sniffing out America's unsustainable debt load. The market and the bond market simply realizes that no amount of money printing can save us from collapse. We could see a no-bid situation for US treasuries. If Japan keeps dumping, China keeps dumping and buying gold, nobody wants to buy up US debt. And on that day, everything we thought we knew about America's financial system could be gone. Obviously, this takes time because we have the hegemony of the system. US likes to point a gun, keep the war going on. And that's another danger of war, because if you look what's happening in the Middle East, they've already started talks that they're going to strike back. Israel and Iran are literally going to start like escalating. It's not slowing down. It's just not being reported. So what does this all mean? The bond market is signaling serious troubles ahead, and the Fed is running out of options. This so-called pivot has backfired. We might have inflation run rampant again. We get another case of Volckerism, where we get a second spike in inflation. In 1980s, that went to 20%, but I don't think we get that high this time. Or maybe it's just high, but we're just not calling it high. We just keep changing the inflation data. So honestly, all data is useless. I honestly stopped using data to have an analysis. The so-called pivot is just bullshit. So if you're not watching the bond markets, you should be, because it often tells us things as it is. And things are getting messy and fast. As much as I think China is undervalued, yes, their price to earnings are actually fair value compared to the US, which is overvalued. The problem is that US is also where money likes to flock to. If you're a tech startup and you want to get capital and funding, you of course go to Silicon Valley. And they also make up about 60% of global GDP. They are also 2 standard deviations away from normal market growth. So when I say it's a ticking time bomb, it is. But it needs a catalyst. And I'm not sure what that catalyst could be. My guess would be either the yen carry trade unwinding or a Middle East escalation. Either one of those 2 things. I don't think we get another pandemic anymore, but one of those 2 things could happen, because if we get wars and missiles and World War III, or a civil war in the US, which is kind of escalating to that stage anyway, I honestly think that this is the most conflict I've seen in my lifetime, although I'm not that old. But also if Bank of Japan, Ueda wants to, am I pronouncing it correctly, wants to rate hike, if they just want to have some balls, because they're just letting their citizens die and their savings inflate away. If they have some balls, they will want to rate hike and keep some form of sovereignty to their currency and to keep it strong. And then that kind of would cause a cascade down, because it's one of the biggest trades. I've talked about it before. There are 3 popular trades: the long US equities, the China short trade, and the Japan carry trade. 2 of these have already unwinded, and they're on a strong trend already. The last one still to have the pivot point is the US. And you can actually see that these carry trades happen from the smallest to the biggest. From the Japan carry trade, and then the second largest being the China short trade. In the tippy top, we have the US long trade, the US tech longs in specificity. Obviously, it's hard to short, as it was hard to long the China trade. But I'm going to say it soon. Within the next 6 months, I think. And then it's being very pinpoint already, because nobody is that good. As always, thanks for watching. If you want more insights on what's really happening in the market, hit the like button, subscribe, stay tuned for more deep dives, and I'll see you guys next time. Bye.